Good afternoon, everyone, and thank you for joining us. You are attending the DBRS Morningstar webinar on U.S. venture debt. My name is Stephanie Ma. I'm a researcher in our structured finance group, and today I am joined by my colleagues, Sergey Masenko, a managing director in DBRS Morningstar's U.S. ABS group and the lead analyst for venture debt securitizations, as well as Kyle Stanford, senior analyst and the U.S. venture lead at PitchBook. PitchBook is the leading resource for comprehensive data, research, and insights spanning the global capital markets, offering an extensive database for not only private equity-focused intelligence, but also expansion into the entirety of the public and private markets. It's worth noting that PitchBook is a subsidiary under the Morningstar umbrella, whereas DBRS Morningstar is a global credit rating business. Back in 2019, Morningstar completed its acquisition of DBRS to expand global asset coverage and provide investors with an enhanced platform featuring thought leadership, research, and analysis. We have over 700 employees in 8 offices globally. A few housekeeping items. Please feel free to type in any questions that you may have throughout the presentation. You should see a question mark on the bottom of your panel, which you can click on and type in your questions. We will address your questions at the end of the webinar. In addition, you should also see links to published research at the bottom that may have also be of interest to attendees. The first research piece is from PitchBook called the Venture Monitor, which not only contains many of the charts you will see later in this webinar, but also a comprehensive deep dive into the venture capital market and trends that we witnessed last year. The second piece is from DBRS Morningstar titled Rating U.S. Structured Finance Transactions, which includes a special appendix devoted to U.S. venture debt. But before we delve into DBRS Morningstar's methodology for venture debt securitizations, we thought it would be helpful to start off with an overview of the landscape with an emphasis on the growth across venture debt. Kyle, let's start off with venture debt volume historically over the past decade or so, along with any major observations on what drove this growth and how it's changed in more recent years.
Yeah, thanks, Stephanie. As you can see here, the venture debt landscape has really advanced as a strategy within the broader venture capital market. We've had 4 straight years of $30 billion or more invested through venture debt loans, which is a huge growth from what we saw a decade ago and much, and further growth from even before that. But what we're seeing is there's been many factors for this. One has been that the venture capital market within the U.S. has grown substantially over that time as well. In 2021, there was $370 billion in equity invested into the U.S. venture capital space. We had 19,000 equity deals completed. And so venture debt has really followed those trends, and it falls somewhere between 10 and 20% of the total U.S. venture market over the past few years. Obviously, low interest rates over the past decade have also been a huge boost to the venture debt market. Even though these venture loans are not the cheapest loans out there, usually falling somewhere around 10% above a reference point, the low rates we've seen have allowed these venture loans to be as cheap as potentially possible over the past few years. Obviously makes them a little more attractive for startups which are looking to lengthen their capital runway as far as possible. But we've also seen this growth come up in venture debt because the returns that venture debt has provided have been very strong. Private debt overall has grown as a major asset class, and venture debt within a smaller portion of that has shown really strong returns, especially on a risk-adjusted basis. So, those are some of the major reasons why we've seen this major growth in venture debt.
Kyle, I want to tease out, you mentioned low interest rates, and I want to tease that part out a bit more. In the spring of 2022, the U.S. had its first quarterly decline in real GDP following 6 consecutive quarters of growth. The Fed then reversed course, pulled back from its accommodative monetary policy measures with 7 successive interest rate increases starting in March of last year, with some as large as 75 bps. I would imagine that the interest rate environment has heavily influenced whether companies have chosen venture debt as a form of raising capital. So I'd love to hear your thoughts on this, Kyle.
Yeah, the switch in the macro environment has definitely had an impact on venture debt. But as a floating rate product, obviously it's going to get a little more expensive when rates rise. But really what the change in the market has done has really had a major impact on the venture capital equity market as well. And that as well is going to flow through to venture debt. But we saw a massive decline in deal value on a quarterly basis, falling 66% from Q4 of last year, or 2021 to Q4 of 2022. And so there's a huge void that is now shown up in the venture market. The venture debt is, there to kind of take the place of. Large public lenders are finding a very fertile space, at least for as the number of opportunities out there, because we've seen so much capital fall out of the venture capital market. And we're specifically talking there about many of the large crossover investors or asset managers that have pushed a lot of capital into the venture market over the past few years. While the slowing deal making environment does add some risk to lending, we've seen and heard lenders are adding back covenants. They're getting some more of the lender protections that have been out there prior to the kind of exuberance of 2021. And so this large fall-off is raising venture debt interest rates, but also adding to the opportunities that lenders have out there.
And what about venture capital exit activity? The process that enables venture capitalists to realize their returns is called an exit. VCs can exit at different stages and with different exit strategies. These decisions on when to exit can heavily influence the return on investment. And I know last year we saw a staggering drop after multiple years of continuous growth. What was behind the slowing momentum that we saw in 2022?
Yeah, there was an enormous drop in exits in 2022, very obvious from this chart. And we're really viewing this as the most important piece of the venture slowdown. And it really thrusts debt into the spotlight because so many companies will need further rounds of funding as private companies. There's 1,300 unicorns globally. So even if we look at this small portion of venture-backed companies, the inability for those companies to exit, especially through IPO, and all this is kind of coming back to the public market shock and the inability or the resistance from investors to accept these highly valued companies into the public markets. But this huge gap is what is causing many of the problems, from equity deal making to companies needing more capital resources that's not going to be there when they need to raise in the private markets. One thing we always want to note that venture debt is not traditionally a gap financing. So while we do talk about the lack of equity out there, the companies that are going to be taking on venture debt in a more traditional sense are going to be very high quality companies. And that's one way that many of the lenders have been able to produce such high returns over the past few years, that these companies, even if their revenue streams may be a little bit choppier than a well-established company, they are generating enough to service these higher interest rates that they take on. So while there have been relatively few exits this year, and there's a 90% drop in the amount of exit value generated, there's a huge portion of large companies that are in need to raise capital again in the private markets. And where they get that financing from, either equity or debt, is going to be a very tough choice, difficult route for them in the next few years.
And Kyle, given this decline in exit opportunities, I would imagine that it's probably beneficial to discuss valuations next. Have we also seen a corresponding dip in valuations at the same time?
Yes, the inability to exit is really pinching the venture market and putting a lot of pressure from top down, really, because of that inability for companies to exit. Really, especially when we look at our venture growth data set and our late stage data set, these companies are valued very, comparatively to how their public market comparables are valued. So when we saw price to sales and price to revenue ratios explode in 2021, so did private valuations. Now, as those public price to revenue ratios have fallen back very quickly, many companies are left with these high valuations with the problems of trying to raise another round of private financing at a higher valuation. And this is where we see venture debt really stepping in and having great opportunities, is that as a non-dilutive source of capital, these valuations lowering in the private markets are going to provide many companies or make debt very interesting for them, as they can raise that capital that they need to continue growth, but not need to reprice their equity shares. That's going to be a benefit for existing investors. It's going to be a benefit for the option pool and the employees, as well as the founders. And so venture debt does have this huge group of companies. I mentioned those 1,300 unicorns globally a little bit earlier, that are going to need to raise capital in a market that is much less forgiving than what they raised in 2021 or late 2020.
When we're looking across the landscape, perhaps we can get more granular with the growth that we've seen by examining early stage versus late stage.
Yeah, so this is a chart that we created, or a methodology that we've come up with over the past few quarters, that looks at really how much capital we are expecting or should be, or is estimated to be demanded or needed by stage, and how much is actually getting invested into the venture market. Right now, we're looking at around $3 or $3 are needed for every dollar that's actually getting invested. And so in this multiple we're looking at here, a higher number is much worse. And you can see that at our late stage and at the venture growth stage that are closest to the public markets, there is much more demand for capital than has been invested in the past few quarters. Early stage has been a little bit different. While it kind of sprung up there at the end of 2022, we have seen seed stage companies in early stage, which we look at as Series A and Series B, as much more insulated from the public markets. And I have only recently seen the spike in demand be unmet by the capital available from investors. There's also some very different venture debt strategies between these two as well. Late stage and venture growth, we're seeing much larger public lenders that are able to make these large loans to companies that are very well established and have very strong revenues. Whereas at the early stage and seed, companies or lenders such as Silicon Valley Bank are able to go in, charge even a lower interest rate than the traditional venture debt, and take on all of those companies' kind of banking assets. It is a much riskier area to lend in that early stage because companies are much less established. But Silicon Valley Bank and other venture lending programs such as that are able to make it work through the investor protections there.
And in terms of alternative avenues for financing, we may see a different landscape this year where it might be much more difficult to raise capital. How has equity fared versus debt?
Yeah, I mean, equity, again, as we've shown, has been very scarce this year. And this look is actually where venture debt is going by stage in our data set. And you can see in that those yellow and green bars, much of the debt has been flowing to those late stage and venture growth stage over the past few years. And those are the areas where we're seeing a very large gap in the equity available to VC-backed companies. We look at this chart as not only showing simply where the deals are going, and obviously many of the venture growth deals are going to be at a much larger size than what we see at seed or early stage. But this is where all the lenders are as well. And this is why when we talk about that gap in financing that we're seeing from the equity markets right now in venture capital, this is where these players from a venture debt standpoint have been playing for the past few years and are ready to help those companies move forward and continue growth in the private markets when they're not ready to exit or unable to exit in the public markets like we're seeing now. With many companies left with few exit opportunities, as well as the slowing supply of late stage capital, we do see debt as a very important financing opportunity for companies in the next year to 2 years.
And if we look at the distribution of the debt sizing, do we see an increase despite the sharp cliff drop in VC deal activity, or do we see a corresponding decline in the sizing as well?
Yeah, so we've seen a pretty significant growth over the past few years, and a nice little spike there in 2022 from you know especially towards the larger end of the market. And this is where these companies are raising much larger debt or much larger loans because the need for runway is so much greater now than it was even in 2021. Without that next round of financing, whether it be equity or debt, as available as it was 2 years ago, these loans are getting much larger, so that companies are able to pull down the line of credit or use the loan for a much longer period of time in order to weather the storm as much as possible. We are not predicting a quick turnaround in the number of IPOs in 2023. And so we see these larger loan sizes as kind of the necessary mechanic of the market to make sure that these companies are able to grow and continue moving forward in the private markets without having that next financing round as available as it was 2 years ago.
Thank you, Carl, for that comprehensive overview of the state of the venture debt market. As a reminder, if participants have questions, you can simply click on the question bar and we will answer those at the end of the presentation. Now I'd like to turn our attention to DBRS Morningstar's venture debt rating methodology that was introduced late last year. Sergey, perhaps as a starting point, you can walk us through the developments.
Sure, Stephanie. Good afternoon, and good afternoon to everyone on the phone. Thank you for your interest in joining us today. Last year in November, DBRS Morningstar published the updated methodology rating U.S. structured finance transactions, which contains as one of the appendices the appendix dealing with the rating approach to assigning ratings to U.S. venture debt ABS. Obviously it's still recent, and we continue to learn about the asset class and gain new knowledge as we talk to market participants, observe performance of the existing transactions. But I would like to note we already have 2 publicly rated outstanding transactions in this space. Both had been sponsored by Horizon Technology Finance. And like I said, we continue talking to market participants, including potential first-time and existing ABS issuers in this sector.
Okay, great. But before we delve into that a little bit more details, Sergey, about our rating approach to venture debt securitizations, I think it might be helpful to take a few steps back, highlight observations that you have gleaned regarding particular features attributed to venture debt collateral and the transactions that we've rated.
Yes, you're right, Stephanie. It is important to note how unique, in a sense, this asset class is compared to, let's say, middle market loans or small business loans. As we've been developing our methodology and crystallizing our views, we've focused on these unique features, several of which I would like to discuss here today. One is, obviously, as many on the phone are well aware, is that the historical performance of collateral pools in venture debt securitizations when it comes to defaults and losses has been rather impressive, for the lack of the better word, with relatively low defaults and losses historically, which may seem rather counterintuitive given that obligors, development stage companies, sometimes even not generating any meaningful revenues or not able to produce meaningful financial statements, in a sense, meaningful kind of rateable financial statements, if you will. In short, this performance, strong performance in our view, can be explained obviously by many factors, but the more important ones include underwriting experience of established originators and sponsors in the space. We all know that many companies supported by venture capital, relatively a lot of them fail. However, we don't see that rate of failure and default in venture debt securitizations or in venture debt space. I think to a large degree it could be attributed to the experience by the originators in picking up the right obligors on the right conditions, and sponsored and supported by venture capital with a track record of working with venture lenders, as well as supporting their portfolio companies through kind of rough patches like the one that we are experiencing now, for example. Secondly, I would like to know the specific loan terms and protection afforded by the loan terms. The most obvious one would be, for example, the first lien. These loans are often senior secured first lien loans with all assets of the obligor being pledged as a security for the senior loan. Sometimes there may be negative pledge on intellectual property, but the bottom line is that the venture debt lenders, they do have a significant control over the fate of the company come the situation where there is a liquidation or restructuring or recapitalization or workout being discussed if the company runs into difficulties. Which brings me to a third point, which is relative to this position of negotiating power. The place of venture debt in the overall capital stack is smaller than that of the equity, and obviously being in a senior position, being a relatively smaller piece of overall picture, however, holding significant control over the final outcome provides significant negotiating leverage when it comes to maybe coming out with ways to get repaid in a difficult situation. Moving on to another observation regarding this collateral, we noticed that vintage-to-vintage performance of venture debt collateral pools is very variable. Even for sizable vintages, you can see variations year over year. Some vintages come with zero defaults even, and some have the defaults in double digits on a cumulative gross default basis. Over the long run, the cumulative gross default rate, in our view, kind of trends toward mid to high single digits for the portfolios with long performance track record. However, you can see year over year fairly significant variability. That also applies to sector-specific performance. For example, if you look at healthcare versus technology versus life sciences, there is a fair degree of variability in performance from vintage to vintage. And interestingly, the performance between sectors does not necessarily overlap. What I mean by that, you may have a fairly high default. Hello?
Hi, Sergey. I think we just had a momentary glitch there. We were up to kind of the fourth point.
All right. Apologies for that. Looks like, I lost audio for a second or two here.
No worries.
So basically, I was talking about variability in vintage performance from vintage to vintage, and moving on to another point, which is a related point, that venture debt performance cycles may not necessarily overlap with more kind of broader economy recessionary cycles. For the subsets of information that we looked at when we were working on the methodology, for example, we looked at some vintages. We saw in some cases 2008 and 2009 vintages, for example, had 0 defaults. We also didn't see, we have not seen so far, any kind of meaningful impact from COVID-19, for example, on performance. However, in some cases, the cycles do overlap. For example, 2016 vintage, where a lot of commercial asset classes experienced a bit of a stress. Also, we've seen the same sort of kind of tendency to happen in venture debt space. So it's somewhat, counter-cyclical or idiosyncratic asset class, if you will, but sometimes the cycles do overlap with broader economy. In all of these factors could be again attributed to basically, the fact that the asset class depends on venture capital inflows, and basically, with the expectation of the exit, be that IPO, acquisition, recapitalization, merger between the firms, and the healthy venture capital industry, kind of tends to benefit venture debt lenders, as was discussed earlier today. Senior position of venture debt lenders helps, focus of lenders on working with companies supported by VC firms that tend to kind of manage their portfolios well and support their portfolio companies. On the other hand, variability is driven by somewhat high obligor concentrations, and this is particularly interesting based on what Kyle showed to us earlier in this presentation, that the size of funding gets bigger. Obviously, it becomes a factor where one or group of large obligors in a portfolio may swing the performance in fairly material way. Last point regarding the historical data that we reviewed while working on the methodology is that recovery rates for venture debt sector typically have been relatively high in our observation, which again may be explained by seniority of these loans. First lien secured loans, even if they are second lien loans, usually subordination is only to specific asset-based line, which is backed by specific assets or receivables. There are other factors obviously contributing to that, but recovery rates, somewhat counterintuitively also have been relatively high for this sector.
Just to summarize those four main points, we've seen historical performance of the collateral pools in venture debt securitizations have relatively low defaults and losses. The vintage to vintage performance of the collateral pools may vary even for sizable vintages. And then we've also seen kind of this, they may or may not overlap with recessionary cycles for the broader economy. Specifically in the 2008 to 2009 vintages, we saw 0 defaults. And then lastly, Sergey, you mentioned that historical recovery rates for venture debt sector has been relatively high, and that could be explained by the seniority of the loans. Now that we've covered kind of the attributes of the underlying collateral, perhaps next you could walk us through DBRS Morningstar's analytical approach to rating venture debt and various assumptions that we apply.
Sure. When it comes to analytical approach used by DBRS Morningstar, it's based on the fairly basic underlying view that the key risk in venture debt ABS transactions relates to obligor defaults and insolvency, and those defaults affecting the likelihood of repayment of the rated debt. Therefore, our focus in cash flow analysis as well as in formulating analytical assumptions for the cash flow analysis is on the obligor default probability and expected loss probability from the overall pool exposures, collateral pool exposures. Specifically, DBRS Morningstar uses its proprietary model, CLO asset model, to estimate defaults in a venture debt ABS transaction collateral pool at different statistical confidence intervals that correspond to a given rating level. When available, we could and might and would look at the credit ratings or any other credit opinions, for example, credit estimates, which may be public or private, for a given obligor if they are available or could be derived. However, as I noted before, some of these development stage companies are not at the stage where meaningful financial statements could be produced. In that case, DBRS Morningstar will use instead the expected cumulative gross default rate over time for the collateral pool and input this expected cumulative gross default rate as the custom PD curve into the CLO asset model. In other words, using the more traditional ABS approach, we would assess the cumulative expected cumulative gross default rate for the collateral pool and use it as an input in the CLO asset model in lieu of using specific credit ratings. We can also look in formulating our base case, specifically PD curve. In addition to the originator data, we could look at the broader industry data. Specifically, if we want to compare how the overall industry performs through the periods of elevated stress historically, for example. It is important to note that this approach using the PD curve or probability of default curve is largely reliant on the availability of sufficient or ample, I would even say, historical performance data through economic cycles, given that variability in collateral performance that we had discussed just now. We would like to ideally see a significant amount of data on a vintage basis going back as far as possible so that we can assess trends and assign kind of our view or formulate our view with regard to degree of variability in performance between, let's say, first lien loans and second lien loans or different industry sectors and overall for a particular originator as compared to broader industry. And so that puts a significant focus on the originators being the experienced managers of these venture debt pools with sufficient track record for us to be able to apply this approach. To deal with another point that I would like to bring up here to deal with the base case formulation where it comes to variability in performance, we can also use different somewhat modified assumptions. For example, if we see significant variability in historical performance, we can apply quote-unquote negative bias in formulation of our base case. What it means, for instance, is that we only use vintages for which cumulative gross default rate was higher than the weighted average cumulative gross default for the overall set of data provided by specific originator. That way, we only focus on more sort of kind of negative trend in performance rather than include everything, including vintages with zero cumulative gross default, for example. We also have the ability, especially when it comes, for example, to more concentrated portfolios, again, looking back to earlier in today's presentation where we talked about growing size of funding, when perceived risk of the exposure, higher risk because of the exposure to larger single obligor becomes substantial, we may adjust correlations in CLO asset model to add additional stress through making a little bit higher correlation assumption than we would typically assume. Generally, cash flow scenarios and cash flow modeling analysis, as well as our assumptions formulation exercise, they take into account obligor and industry concentrations, eligibility criteria, specific characteristics of collateral pool, concentration limits for transactions with ramp-up periods or reinvestment periods, for example. And all of those considerations generally would be reflected in our probability of default curve assumptions. CLO asset model, then once the CLO asset model is populated with all the assumptions, then it is used to determine the basically lifetime cumulative gross default rate for the collateral pool, or if you will, stress default rate or stressed hurdle rate for the collateral pool, which will vary by rating level. The stress default rate, together with other assumptions, for example, recoveries, prepayments, asset yield, is then utilized in cash flow scenarios to determine the break-even cumulative default and net loss rates for each class of rated obligations. And in the end of this process, once we come up with the break-even rates, we compare the break-even rates based on the results of cash flow modeling to the hurdle rate generated by running DBRS CLO asset model. And if the resulting break-even rate is higher than the hurdle rate, then the conclusion is that at given rating level, the transaction structure and transaction collateral would be expected to withstand the stress commensurate with the rating.
Thank you, Sergey, for that very comprehensive overview.
Yeah, it's a little bit drier than the kind of slides that we saw before. Unfortunately, it's always the case, almost inevitably, when it comes to the methodology discussion. I think the bottom line, in this sector, we would be expected to use, pooled approach, quite traditional ABS-like pooled approach, looking back at the static pool performance for a particular originator quite a lot. And once we formulate it, we will generate the stress hurdle rates by applying our CLO asset model. And then by going through the typical ABS-like, cash flow scenario exercise where we reflect other assumptions as well as default assumption and liability structure for the transactions, we compare the outcome of the cash flow modeling to the hurdle rate generated by the CLO asset model.
We've thrown a lot of material at our audience. This concludes our prepared remarks for the webinar, but now we'd like to open the discussion up for Q&A. And again, you'll see a question mark on the bottom of your panel, which you can click on and type out your question. I think I saw one or two come in. Let me just check our bar. Okay, I know, let's see, the first one. What are the major factors behind the relatively low default rate? And I know, Sergey, you touched on this briefly before when you talked about it's almost counterintuitive with the obligors being development stage companies, but we see a strong underwriting experience of these established originators, specific loan terms and protections afforded, and then specifically where the venture debt falls in the overall funding stack of the developmental stage company. So I don't know if Kyle or Sergey, you want to jump in, maybe just to reiterate what the major factors are behind the relatively low default rates. And then the second part of that is, do you foresee this trend changing this year given a potential recessionary environment?
Yeah, I can add a little context to that from our perspective at least, but one reason for the relatively low default rates is that these lenders are really lending to high quality companies, right? These companies are backed by large investors who also have an incentive to make sure the company stays afloat for a next private round, because there are not there's not a critical mass of lenders out there willing to take on this risk. So as the loans come into these companies that are backed by strong VC firms, the capital is also used for growth, right? And it's not a typical lease financing loan, or it's not a typical operating capital loan to get to the next month's payables. This capital is going to companies that are very aggressive in their growth and should be relatively well developed from a revenue generating standpoint. So kind of all those factors combined are really helping keep down that default rate. Many of the lenders we talk to are very proactive as well, working with the companies, making sure they have insight into the sales and revenues and cash balances to make sure that they can leap in before a default happens. It's much more it's a much better outcome for these lenders to make sure that the companies don't default. With many of these loans secured by intellectual property, if the company were to go out of business, then that intellectual property might not be there to fully pay back the loan. And so being able to jump in, refinance a loan, or work with the existing investors and existing equity investors to make sure that the company is able to get the capital they need to continue growing or get to the next equity round are some of the major reasons why we've seen defaults stay low. Now, I will add, obviously, with the potential or recession that we are or potentially in coming up, that obviously adds risk to these venture-backed companies. Many are going to be much less developed than they need to be to weather a full economic recession. But I think lenders will stay very, active in making sure that they are up to date with the companies that are using their capital. I think the level for that these companies will need to hit to secure a loan from these lenders, I think, is going to rise. In 2021, we saw in the venture market, it was relatively easy for companies to continue raising rounds, debt and equity. But those, baseline cases have increased substantially from an equity financing perspective, and we imagine those will also increase and become more stringent for securing a debt loan as well.
Thank you, Kyle. See, any more questions? One just came in. Does DBRS Morningstar have any rating caps on ABS backed by venture debt? Sergey, that one sounds like it's for you.
Sounds like it, yes. Yeah, I can take this one. We do not have any formal rating caps. We generally, it applies to a lot of other asset classes. In general, our ratings, formally, we don't maintain rating caps. That being said, this asset class is being relatively new for us. We just published the methodology, even though we looked at this asset class, obviously, for years. And we still continue to, observe and get the information, collect the information, accumulate the knowledge of the asset class with respect to performance under different circumstances. We've had COVID. We now have a recessionary scenario after a fair bit amount of time, and a really active period for, venture capital and venture debt industry over the last, 5 years, let's say. So given that and, still evolving nature, increasing funding size, we would obviously want to exercise a bit of extra caution in terms of how high in terms of ratings we would want to go. As we accumulate the information and experience and add more and more rated transactions to our surveillance and monitoring, obviously it's a natural process that developed with many other asset classes. We would feel more comfortable going higher in the rating spectrum. I also would like to point out that many transactions out there in the space also do not necessarily look at highest ratings. maybe it's just the balance between the level of stress and level of enhancement that the sponsors need to allocate to achieve higher rating vis-a-vis the cheaper funding. But what we've seen is that kind of ratings tend to be in kind of middle investment grade range for this space so far.
Thank you, Sergey. Last call for questions. Okay, I believe we have addressed all the questions posed. We want to thank each of you for taking time out of your day to join us. Special thanks to Kyle and Sergey for sharing their invaluable insights on the venture debt sector. Just a note, this webinar is being recorded and will be available for playback should you wish to revisit any discussion points or perhaps share the replay with your colleagues. Thank you again for joining us and enjoy the rest of your day.